Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Welcome to Property Investing Insights Client Stories, and today I have a very good friend of mine who tends to send me very long emails, and the going joke we have between us is that I try and reply as concise as possible. Today we had lunch first so that I could then, his thought process was that, we'll prep for the podcast. Little did he know that we want to roll this as authentic as possible. So there's no pre-rehearsing or coaching on questions and answers. And so with that, I'd welcome Peter Shulz. Welcome, mate.
Thank you.
Been a while. We did take a while to get you here.
Yep.
Thank you for being here, and thank you for sharing your story with our clients.
Yep.
Your journey's been a while. When did we start?
2018.
2018, right?
Yes.
So we haven't quite hit the 10-year mark yet.
Nope.
When you were already an investor.
Yes,
when
indeed.
Started.
Yes. Yep.
Yeah. So let's backtrack one. What does Peter do?
We run our own business, industrial supplies.
Yep.
And we've been doing that since 2010. So it's my wife and myself, and yeah.
And you got two young kids?
Yes.
Yeah.
Carla turned 10 yesterday. Henry is 7, and always busy.
Yes.
Primary school age, so lots of activities. And yeah.
Tell me, have they picked up the property jargon yet?
They have no idea, no. So no.
It takes time. Yeah,
It
but
will,
they will.
yes.
They learn through osmosis.
They will,
yeah.
yes.
Yeah. So when we started, Peter, you already had an investment property.
Yes.
Let's talk about that first, right? So what got you into the investment bandwagon to begin with? And then let's then talk about the journey so far.
Yep. Well, we're in Australia, so there's a bit of an accent here. I came to Australia in 2007.
Are you talking about me, about the accent?
No, mine. And so we came to Australia in 2007, and we've been following other investors, I guess, seeing their successes, and in terms of being prepared for retirement and planning for the future, we figured it would be a good idea to also get on that bandwagon, and we did. So we approached you, and it was actually Steve Waters who I spoke to first from the Right Property Group, and
Fantastic. And so obviously you already had an investment property when we first met, and so you already knew about property investments.
Yes.
What was the difference in terms of, first of all, coaching in terms of mindset and thought process that we went through in terms of initially starting? What was different to what you had initially bought the property, the first investment, to property investment number 2?
Yeah. I guess the first one was mostly transactional, because there was a certain brief involved, and there were not really any strategy sessions to start with, which was okay at the time because we didn't know better, I guess. So once that was settled, as I said, we approached you and heard you on the podcast, of course, where else, and had that strategy session with Steve. We wrote down a plan on how to move forward, and a few months later we basically purchased property number 1 with you, and have added a few more over the years, and we really enjoy the annual, if we're lucky, biannual sessions to check in and just do reviews with you. So,
Yep, no, absolutely. So the first one was obviously in Queensland. It was a duplex, and if you recall back then, it wasn't quite the flavour at the time. Queensland was just coming into its play in the investment circles. Everyone was concentrating in New South Wales and Victoria back then.
Yep.
And so that was a bit of a take away from the general investing thought process.
Yep.
And so we got the duplex in there. And what was the approximate purchase price back then?
540.
Okay, for a duplex, right?
Yes,
now,
for a duplex,
similar properties today, you'd be talking upwards of $1 million. And obviously having 2 rental incomes would really make it an easy property to hold.
Yep.
And we were just looking at the numbers beforehand, right? And it's just slightly negative with today's interest rates.
Correct,
I think to the tune of about $6,000 a year, which, really, you drink more whiskey compared to that, right? So
No comment.
And he says that with a straight face too. So
But good quality whiskey. So
yes, well there you go. There you go. Which is another hobby of yours, right? On a side
Yes, it
gig,
is.
that
Yes,
you
yes.
do get premium whiskies, which I attest to. I've been gifted that, and I've been taken to task today of not having sampled it as yet.
Yes.
We will soon.
Yes.
Yeah. So obviously, you've bought a property in Queensland. The property market at that time wasn't quite taking off. Where was the next play?
The next one was in your area, obviously, the neck of the woods in Campbelltown, in the Campbelltown area.
Yep.
And we actually exchanged contracts the week before the general election in 2019. So a lot of controversy at the time about the end of negative gearing, Labour taking this to the election. So that was a good opportunistic play, I guess.
Yeah.
Purchased a termite damaged property that required some repairs, I guess, and renovations. I think we spent maybe $60,000 on that.
Yep.
Picked it up for 400, and yeah.
Yeah. Today it's worth 950 easy. Again, this was not a pretty house. It was just a stock standard house. In fact, I remember the discussions back then to say, how can we make it pretty? And the recommendation was just leave it alone. Just fix what needs to be fixed, and let time do its magic, which has worked pretty well, right?
Yep,
so
it has,
now that property is self-sufficient.
Yep.
Have you had many turnover of tenants on that property? So we're talking 2018 on this one, isn't it?
Yes, 2019. I think April 2019, and I think we're on the second set of tenants.
Okay.
We had one change since then.
Yeah. And this is a unassuming 3-bedroom carport from memory.
Yes,
No
correct,
garage.
correct.
Sitting on
I think we enclosed the carport to make it a garage.
Yes.
So, yes.
Yeah. Now this is a big change from the strategy in terms of you bought a duplex. Now you've done a renovation. How did you handle the mindset shift from a buy and hold straight purchase to something that you tinker with? Was it something that you were looking forward to, or was the business case there that it just simply could not fail?
I think it was a bit of both, because we knew what was at the end of the process, so it couldn't really fail, I guess. But it's something that we know from our work, so it was just project management and having timelines in place and finding the right people to do it. And,
And how much of the work did you do yourself?
Not much. At the end, we cleaned up because tradies seem to have an issue of cleaning up their workplaces afterwards, but we did that.
Yep.
So it's about a 2-hour drive from where we live, but
Yeah. So majority of it is just done off-site.
Remotely, yes,
So,
correct.
and that is the trick, right? You want to be leveraging the time, provided you're not paying an arm and a leg. It's always better to get someone that does things on a daily basis to do that task. And we stick to, as they say, stick to our knitting and making sure that we're getting the money in and getting good quality work done on the other end. Now, obviously, being that it was termite damaged, not infested anymore, it had ongoing small repairs along the way, which was part and parcel of the thought process in the property, that this will always have niggling repairs, but it'll have phenomenal growth, right? Because we're largely investing in the land with income coming in from the property itself. Have you had any revaluations done on that? Have you extracted money out of it as yet, or not yet?
We have not, no.
Okay, so it's sitting with massive equity at the moment. Let's talk about the rent on that one. So when we initially bought, that was $350. What's your rent now? $570. So that's almost a doubling effect. Not quite there yet, but give it another 2-3 years, rents would have doubled, which comes into play with if you held properties long enough and you didn't add to the loans, that it can become self-sufficient very quickly, right? And by very quickly, I mean, a 10-year time frame, or again, depending on the cycle in the area, because we're talking 2 cycles, right? The growth cycle and the rent cycle. And assuming that there's no big green space that is being redeveloped in the area. So we've done well on that one. And then obviously we'll go through the properties really quickly, and then I'll come back and talk about mindset. So we've got roofs done. And then what was the next play?
Victoria, Geelong area.
Yep.
I'm not sure if you would call that a duplex as well. So it's two
Yep.
neighboring properties, one shared wall, but two separate addresses. So
Yes.
yeah.
Yeah. And what was the intent on what was the strategy on that property?
So the intent is to hold it at first, fairly rundown properties, but
Yes.
the area, there's a lot of development happening and fairly large land sizes. So the idea was to develop eventually, I guess, and townhouses was on the cards, I think.
Yep.
And from memory, the neighboring property is also a right property client, so possibly do something together there.
Yeah, yeah. And this is walking distance to the staple diet in the area, KFC
Yes.
and McDonald's and
Yes,
so
it
forth.
is.
I say that in jest, of course. But this is like walking distance to amenities, which makes it a really good development site. And we've picked this up from memory around the 440 mark.
420, so it was below land value at the time.
There you go,
So,
yeah. And we've gone through one cycle in that area. So now if we were to put that on the market, probably get an easy 450 to 500 each side. And this is one where we've got the roof joining
Yes,
across
yeah,
it. So ownership on this one, we've got.
I have one side and Andrea has the other side.
Okay, yeah. We've obviously, since we've bought it, we've hit land tax. And every property that's worth buying in Victoria at the moment is subject to land tax. How have you handled that, and how has that impacted the holding capacity of this property?
Just an additional expense, I guess. So it's from memory $950, I think the lowest rate that is possible. They need to repay their debt somehow, I guess, in Victoria. So yes. Yeah, it didn't really make a difference, I guess. So we had the capacity to pay those additional charges, and there's also the additional charges for the compliance every 2 years.
Yes.
That also comes into play.
Yeah. So it's you know, these are things we can't control, right? When you're buying properties, these are things we absolutely cannot control because they are part of a sovereign risk. There is no way of predicting that will come into play. And this is why you never redline your holding costs, because these left field extra holding costs could come at any point in time. You need to have the capacity to hold on, right? Now it's important to understand that every property that you've bought, once it's gone through a little bit of its own time, it can stand on its own two legs in the sense that it's got its own equity, it's got its own rental, and there's minimal negative cash flow. But that wasn't the case right in the beginning, right? We always landed in negative cash flow. So overall in your portfolio, now we're talking quite a few properties. What's your holding cost, excluding your principal place of residence?
Oh, I need to look at my sheet here. Including the commercial, or?
Including the commercial.
Including the commercial. So we're actually positive now. And
and that's important, right? We started with negative, we've gone to neutral where the rates coming down.
And we knew it would take some time, so we had the capacity and plan for it accordingly to hold on to the properties and basically generate the growth or wait for the growth to happen. And then together with the increasing rent as well, the holding costs came down as well. So.
And the neat little topper was obviously the commercial that then washes out all of the negative cash flow. So we've got obviously the first property, which I'll circle back to, which was done outside of our ecosystem. Then we had Rothwell. Then we had the first New South Wales property. Then we've got the Victorian property, the Geelong property itself. So we're now talking, so including the very first one, 1, 2, 3, 4, 5, 6 rental income streams coming out of literally 3 or 4 purchases. So what was the next addition to the portfolio?
We went to Western Australia, to Perth, suburb called Maddington, picked up another duplex. The last time that one traded was for $200,000 more than what we picked it up for, and that has seen phenomenal growth as well. The rental income went from $180 per site to $450 per site. So
in a space of how long?
That was just before COVID. I remember it was early March 2020 that it settled. And
so within 5 years, it's pretty much almost doubled. Well, actually
more
doubled
than doubled
the rental. And the value, of course, has shot up as well. Because often
That's
what
right.
happens is when rentals climb up, the values do climb up as well.
Yep.
It's not usually not the other way around. If the values go up, the rentals might not track up along with it, right? Which is what's happening in Victoria at the moment.
Yep.
You've got phenomenal growth, but the rentals aren't keeping up, so it's harder to hold on to these properties.
Yep.
This Maddington property, although it's got 2 rental income streams, this is also a potential development site.
It is indeed, yes.
What's the eventual plan on this?
I think we were talking about up to 6 townhouses on this property.
Yep.
It's fairly large. It's 1,400 square meters. It's in a great location. It's zoned accordingly as well. And
Yeah, and we were discussing earlier that we're sitting on all of these sites where we could come back, we can put multiple dwellings in there. And whilst they made sense in the beginning when we bought them, right now with building costs the way they are, how illiquid some of the builders are, it's perhaps not the right move within the portfolio. And this is a constant discussion we are having that, okay, where to next? What to do next? Can I pull the trigger and do the development? And when we've had that conversation, we always come to the conclusion that perhaps it's not safe enough to do the development.
Yep.
But eventually we'll come back and,
Yep.
and do the developments on this. So these are properties that, whilst they're fairly ordinary at the moment in terms of constant repairs and maintenance, we bought them well below land value.
we did. Yeah.
And it's a time to simply go back to them and execute the full strategy on each of them once they are standalone developments, which they are at the moment, albeit the construction cost a bit too high.
Yep.
That'll bring us brand new properties, no maintenance, and multiple rents with equity gain as well.
Yep.
So when we've taken that flavour, what's the next property we've added to the portfolio?
We went back to New South Wales and Central Coast,
Yep.
suburb of Berkeley Vale. Purchased a for the area, fairly large block of land, level, flat, 800 square meters,
Yep.
with the potential to subdivide and put a granny flat on, or
A second,
remove
second dwelling
income.
as well.
Yeah,
Yeah. So then in the midst of that, you've also upgraded home.
Now that was slightly later, so that was in September, October 2020, I think, and the commercial came first. Not sure if the order is important. We upgraded homes 2.5 years ago in January 24.
Yep.
23.
Yeah. So when you say you upgraded the home, did you keep your original home?
We did indeed, yes. Turned this into an investment property. And the plan is to hold on to this at least for one more cycle and then sell it if we have to sell it in the first place. It's a 4-bedroom house that we really enjoyed living in. And
Yeah, fantastic. And then when we've bought that many properties in New South Wales, obviously we've hit land tax.
we have, yes.
And that too brings an extra holding cost.
It does, yeah.
And often what happens is that, especially when you're talking about transitioning your home, right? So moving from one property to another, this is the reason why most people sell down their original home. One of the reasons could be that it's capacity, so ability to hold on, or extracting the deposit. The second is the hitting land tax. But we've taken a deliberate approach to say, you know what, we'll cop the land tax on the chin because we can actually see growth that's going to be well beyond what the land tax component is going to be. But it is a pain, isn't it?
It is, absolutely, but it's not an expense that is a deal breaker. I think we're looking at 2 or 3K a year, and if you split that across 4 properties, I guess it really is not the end of the world. It's an additional expense that we budgeted for. So
and once we've done that, we've then bought the commercial.
Yes.
The commercial then obviously topped up beautifully, and now we are in talks to get the next commercial. And the conversations we've been having is that, okay, where does all of this end? And you've got a good problem, right? Because you've got a positive cash flow portfolio, even though you're holding more than your standard investor in Australia out there. We've got a positive cash flow portfolio. We've got lending that's opened up for us. You've got the ability to extract lots of equity out of different properties. And now we've got the good problem of, okay, what do I do next? Because everything's possible. So if you circle back to the very first property, and you did tell us interesting story there, where you gained a property as well as a family member.
We did indeed, yes. So our son was a planned cesarean, and we had been in negotiations about that property that we bought outside your ecosystem. And on the way to the operating theatre, we basically had a phone call from the agent saying if we increase the price, then the property can be ours. And we agreed to do it. And when we left the operating theatre, we had a signed contract and a son. So, yes.
So 2 expensive things.
Indeed, yes. That's not too bad yet, but might
Well,
still
there
come.
you go.
Yeah.
But that property, whilst you did potentially overpay initially,
Yep.
this is a good testament of right area, right type of property over a period of time. It does work okay.
Yep.
So now that zoning's on that's changed,
It has,
and we
yes.
can now put a multi-rise on that.
Yes, we can.
Not that we're planning to, but that's something good to tuck in the back of your pocket as well.
Yeah, it is. Yeah.
It is by far one of our most negative properties as well in
Yes.
terms of cash flow, but
Yes.
we've got all of the other properties to actually support it.
Yeah.
If you were to look at your journey all over again, right, and we had everything possible and you had the vision you have today, what would you have changed in your journey?
You get the same answer that most people give you when they're sitting here. Buy more when they could have, I guess.
Yeah.
But other than that, you said it before, the portfolio is more than neutral. It's actually positive by now. It has seen phenomenal growth. I'm happy the way it went. So yeah, no complaints really, I guess.
Yeah, and that's true. And any person that's sitting here, that's the same answer. They say, we would buy more if we could, or
if we could have. I guess.
if we could have, but it's not. You can't see that vision while you're going through that process.
No,
It's always hindsight, isn't it?
Yeah.
Even in my portfolio, I look back and I say I could have gone a lot more harder, even though I've gone fairly hard. And that's purely because you don't see that value growth unfolding. I mean, if you look at Roos property, right, from 400 to 950, you wouldn't have imagined that in less than 10 years. We've held it for 7 years now.
Yep, 2019.
Yeah, so it's something that does rear its head up in the journey, and this is where people do get a lot bulletproof, so to speak, where once they've got a good baseline of properties, they try and force the numbers because then they get into the transactional side of it and buying more and more.
Yeah.
And one of the conversations we always have is, okay, where's my next one? And I'm always pushing back to say, well, we've got to get the right one.
Yeah.
And that the journey actually slows down quite a bit when the portfolio gets bigger.
Yep.
Because each property now that we add to the portfolio needs to be more and more exact. And it can actually upset the apple cart if you get it wrong.
Yep.
It's very easy to get it wrong because you've had the success
Yep.
all along, right?
Yeah,
And when you started out, what were we talking about in terms of interest rates?
I think we were at around 4.5% maybe.
Yep.
And then obviously during COVID, I do remember it was quite painful when COVID ended, that the fixed interest rates went from, I think we had 2.09 was the lowest we could get, and when those reset to north of 5%, that was quite painful, but that's just the way it is, and certainly nothing we can influence. So
So as a household, how did you handle that change, pretty much doubling if not trebling of your expenses?
Again, budgeting for it, and we diverted additional funds into the offset accounts during the lower interest rate periods, because that just made sense to us to do it that way, to reduce the interest repayments even further. And when they reset, that the blow wasn't as bad as it would have been if we hadn't done that, I guess.
Yeah. So you really looked at in from a future pace to batten down the hatches while there's money coming in. So you put that in the offset account, and then you because we're doing regular portfolio reviews, we are flagging when things are coming off fixed rates, when they're coming off interest only, and planning for those. And is your lending only with the one bank, or is it with different banks, or is it bit of both?
We have transferred large chunks of it to one of the big four banks.
Mm-hmm.
We're now part of their private banking ecosystem, I guess. A handful of properties, 3 are still outside of that ecosystem, and
Okay, so let's, for those that don't know, right, if you've transitioned from retail banking to private banking, how does that work? What was different?
we get more phone calls from them, but updating us on things that are not necessarily relevant. But other than that, I don't think it's as great as people make it out to be. So I don't think we're getting really any benefits, extra benefits that we wouldn't get if we weren't part of that
apart from
program.
a designated point of contact that you could call.
Exactly, yes.
If they stick around long enough.
Well, he's been around since then, so but no.
Yeah, I know my personal bankers changed about 4 or 5 times in Westpac, and the same with Macquarie. They change, and that's part and parcel of, if they get too good at what they do, they've been moved on to less performing portfolio, so they can bring that up as well. Then you get someone new, then you have to retell your story.
Yep.
But it does make sense. As your portfolio grows larger, you want these relationships, and this was. I guess the next question is, did you go direct with the bank or did you use a broker?
We used a broker, have used a broker since day one.
Yep.
And have been very happy with that decision. Would always and have recommended him to friends, and they have used him as well with good results. And shout out to Luke, I guess.
Yep, absolutely.
He's also a Right Property client.
Yeah, so for those that want a broker, we can certainly recommend Luke. Contact us for details. And Luke, you owe me a wine for that. So this is important, right? In terms of brokers, if you're going through this journey, you are an unusual client because you own more properties than the ordinary person. And this is purely talking stats, right? And when you have a broker that comes into that mix, they need to be of the same mindset, right? And so I know that you and Luke have long conversations in terms of strategy, finance strategy, and he's dialed into your portfolio as well as to what you're trying to achieve.
That's because his responses are more than 1 line long.
I'll take that into account.
Yeah.
I'll make it 1.5. Yeah. So if we hadn't used a broker and if we went direct to the bank, being self-employed as well, it does make it a lot harder in some cases. In some instances, depending on the lender and depending on your personal banker, the initial journey is easy, but as you add more properties to the portfolio, they tend to then put it all together. And it does, if I take, say, your Maddington property, let's say we pull the trigger to develop that, and we'd gone down the route of having everything cross-securitized, which is what most banks do for self-employed, you then would have put everything at risk, right? So this is where someone like Luke comes in really, really early in the piece to make sure that everything's set up correctly. So everything's held within its own silo, and we can independently pull the trigger to materialize the full strategy on the properties that we hold. Would you buy Roos all over again?
With the task at hand or in general?
Absolutely.
Yeah. I actually enjoyed the fact that it was not a set and forget property, but that there was some work involved, and thought that was a great challenge, and the results proved that it was successful as well, I guess. And I would,
Okay. So what's been the most challenging aspect of property investing for you?
Being honest, that I outsource most of the admin work to my wife Andrea. So it's not that. What I found challenging sometimes is property management. So we talked about this before, and also I heard it on your podcast. So many changes with contact people issues, but also getting issues, getting quotes for repairs and maintenance because problems finding available tradespeople to do the work. So I find this quite challenging. What I also find quite challenging sometimes is, I have to remind myself of the phenomenal growth that we've seen with most, or if not all, properties, but if that hot water heater goes, it's always a bit of a, not really concern, but you know, it niggles and
Another repair.
exactly.
Yeah.
But then you think about the expense and look at the growth that year or overall. So,
which is keeping things in perspective,
Yes,
right? Because
yes.
you can get caught up in the weeds and say, okay, you know, this property is getting too many repair requests and so forth. But if we spending a couple of $1,000s a year, but we're getting multiple thousands in growth,
Yep.
and it's not bleeding us from our holding cost, that's okay. That's part and parcel of property investing.
Yep.
On the strategy that we've embarked on, right? Because you've got a bit of time on your hands, you've got the right mindset, so it's okay to do repairs. For someone that doesn't have the time frames in mind or the mindset in place, the portfolio would look very different.
It probably would, yeah.
So if someone was starting out today, now obviously we've talked lower numbers, right? So we've purchase price of 400s in most of them. If someone is starting out today, obviously the 400 properties aren't possible. What's your advice to them?
Find trusted partners the same way that we did. So speak to your accountant, I guess, your mortgage brokers, the right buyer's agent. The right buyer's agent, yes.
Good plug.
Trust the process. It's worked for thousands of investors, and don't be scared by the numbers, I guess. Have buffers in place. Be prepared for holding costs because they're part and parcel of it. You're not going to find a positively geared property from day one.
Yep.
And start any month, I guess, that you delay is going to be a problem because interest rates, or not interest rates, like growth that you miss out on. So get started sooner rather than later. Trust the team in place and trust the process.
Look, I have a simple rhetoric to people that say, you know, I'm going to buy in 2 years' time. And I go back to them and say, so what you're saying to me is that you are willing to pay more for the same property, right? Because
Indeed,
that's what most of the growth trajectory is. But also in the same breath, I also ask people to slow down because you need to be able to hold on to the property as well. So you've done phenomenally well with multiple property purchases, whereas that might not be entirely possible today. If they had the same income as you, it may not be possible today because what was 400 before is now 950,
absolutely,
right?
yeah,
So you need more deposits.
Yeah.
The rents haven't quite kept up with the growth, so there is more negative cash flow for each property. So it will take longer for it to reach, if we did nothing to the portfolio and just buy and hold, it will take longer for it to reach that status where through interest rate reductions and rent increases, we are at neutral. So it does take time, and it does take a lot of planning, constant planning and replanning, and a sheer will to stop buying, which is the most important bit as you start getting a few runs on board. So what does the barbecue conversation look like at your place?
I try not to go into too much detail, which I might have just shot to pieces now with this conversation, but so friends know that we're involved with property investment, that we're quite successful as well. Maybe not about the scope, but we have recommended your services to a few of our friends, not necessarily after barbecues, but in at least one case, yes. And so we do talk about property, but it's not our number one conversation. And
it's important, right? Because it can't be life consuming. So it is something that is happening in the background. Yes, you're giving it priority over other things, but only when it is due, right? So it's not life consuming that you're talking property every single day. And how do you keep yourself motivated?
For property?
Yes.
In general?
Seeing that all these repair bills come in all the time?
No, well, obviously the success that we had, that is a motivation to do more, I guess. Motivation in general, knowing the outcome, knowing what is at the end of the journey, and working towards that, small steps every day to make sure that this is what the end of the horizon.
So as we come to the tail end, how would you, what recommendation would you give to someone that's already got a small portfolio? What's some advice that you can give them?
Circling back to what we said before, speaking to the right people, put a strategy in place. Transactions are not, and I didn't learn it the hard way, it's the wrong way, but there were phases in the build-up where where the mistake for me was confusing success with transactions, which is not necessarily the case.
Yep.
So instead of adding properties to the portfolio that might not have a place in the portfolio and might actually be damaging to the portfolio, make sure that the property has its place in the portfolio and adds value to it. And to have an exit plan, that's always very important. So each of our properties, we know what we can do and how we could get out of it. So those would be important.
Yeah, and I'll latch on to your phrase of having an exit plan on each property. Why do you think that's important?
Because, well, few things, I guess. You never know what the future holds. So some of the properties we could liquidate within 6 weeks and have the funds available if we needed to. Yep. And others, there's the development potential that we could be using to repay debt or possibly to hold for income long term. Yeah,
it just gives you options, right?
It does, yes, indeed.
It gives you the sleep at night factor.
Yeah, it does.
And for someone that's in research phase right now, and I know you do a lot of research,
yes.
and listening to all these different podcasts with mixed messaging, what's one recommendation you'd give them?
I would, again, I'm coming back to the team that is important, but I would definitely go to someone who has runs on the board. So someone who's been in the industry, someone who's doing it himself, who's done it himself, and trust that person with what they come up with. Obviously do due diligence, because you can't outsource the responsibility of signing on the dotted line. But anyone who's done this for 10 years plus would have been successful. And if they're willing to share their journey and make recommendations to you as a service, probably pays to listen. It pays to listen and act on that advice.
Absolutely, and there is a lot of flashy advertisement that's happening right now. So one of the things as we barrel into the new year, be mindful of these ads, be mindful of not pulling the trigger too early. It really comes back to, and this is a testament to your portfolio, it comes back to the holding cost, comes back to having capital available, having the buffers in place, and being able to silo each property so that it has its own strategy within the overall strategy. And slow and steady wins the game.
Yep. Indeed. Yep.
And as Peter said, you can't. What he tried to say is you can't outsource your push-ups. So you need to do the heavy lifting yourself. In other words, you need to actually take action to be able to be successful in this journey, and don't leave it to chance. Peter, I thank you from the bottom of my heart. You've shared your story. It's going to inspire so many people. And yours is not an unusual story, but it is unusual in the fact that you actually took charge and you actually made the decision to make it happen. So thank you for sharing your story.
Thanks for having me. Thank you for giving me the chance to share it.
No worries.
Thank you.
There you have it, in Property Investing Insights. And if you wanted more of the backstories, go back to our YouTube channel and you'll see a lot more of client stories. Until next month. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.